Ooh, that's smoky. Mm. Mm-hmm. Ah.
Look, when it comes to financial freedom, and this applies to any goal that you're going to have, but especially when it comes to money, you got to be very specific. So, for my goals, I have the specific number, like down to the down to the dollar, right? Um, so this applies for your savings, your investing, your income, everything. Because if you're kind of vague and you're like, oh yeah, I want financial freedom, it means like I'm gonna save money and I'm gonna invest it, and then I'm gonna have like passive investments. Okay, but unless you set a real number, you can't really measure where you are today, and then tomorrow, even if something good happens, you're still not going to know how close you are. And look, it's just a lot harder if you don't really have a specific goal in mind. You're going to have a lot of choices. It's a big financial world out there. And so if you're trying to decide this investment or that one, like should I do this or that for my job, like, and so forth, getting specific is just the best thing you can possibly do to help yourself out to achieve your goals even quicker. And you have to review like every day or at least every week and really just sit down and say, okay, here's the goal. You can write it out again if you want, and that helps you to keep really reinforcing it. But review it. Say, like, I made this progress. Here's how much closer I am to the goal, very specifically. And you will see the progress. And so the thing is, like, as you start getting in this habit of having a specific goal and then, making work towards that, and it doesn't even have to be every week. Like, if you work hard one week and you make good progress and then you chill for a few weeks, like, it's not a big deal. You're going to still make a lot of progress as long as you always coming back to it. You have this habit in mind that you're reviewing it. You're saying, okay, here's how much closer I am. And yeah, you literally like see yourself go to the goal. Like, it's very simple. Like, it's not hard. um, but it just takes time. And so that's the biggest thing. People want to get rich quick. But it does take time. Like, you have to literally, it'll take years and years, but of course it's worth it. So one thing you can do, and this is only like this is an advanced technique. Um, if you're not a net income positive yet, don't even think about this. But yeah, basically, imagine that you already have savings, and they're kind of in a safe investment. It's not high return. You're gonna want to invest in something a little riskier to just uh, well, you can increase your return. Like, so when you go in the stock market and you want to buy, like, you want to try to pick tech stocks, it's tricky. Like, not every tech company makes money. So you could buy the wrong stock and you're gonna lose money. But people really get a lot of success from investing in the right, tech companies. So if what you found is that you're doing that and it seems to be working and it's really kind of proven, like, okay, maybe you're good at it. You're actually picking the right tech stocks, and you've done it multiple times, time after time. It wasn't just once. Okay, so then you can say, okay, like, this is a real skill. It's something you've basically invested in the skill itself. You've learned and developed it. So one thing you can do to speed up your investments is actually, well, in finance we call it leverage, but really it could just mean that you're borrowing money to invest. So it is high risk because you have to have savings already that okay, that's in savings, it's earning a safe return. If I borrow and try to put that money into a higher risk investment, it's proven, you've done it several times and it seems to be working, but it's still risky. Like, who knows if this is the time you lose some money. So, but what you can do is, like, let's say you have a mortgage, and you want to take out like a second mortgage. If you can get a good rate, so let's say that rate is like 5 or 6% a year. Well, if you're doing growth investing in the stock market and you're picking tech stocks, that's the kind of thing where you can actually use that second mortgage and you can just continue to invest in the tech stocks. And then, it might be down for the first year, or you might be up and then down for year 1 and 2. But after 3 to 5 years of doing your tech stock investing, which is already part of your, that's just what you do for part of your path to wealth. Well, by borrowing a little more, you're going to compound your gains, because as you do gain, and like, you're good at it and you're gaining money. So by borrowing some, you're increasing your initial capital. So when you get those gains and then you use the whole gains, or a standard size per per investment, you're just gonna see after 3 to 5 years, like, maybe double the growth compared to if you had not borrowed any money. And look, at only 5% for like a second mortgage type of thing, it's a very good deal. And so my grandfather actually did this to great success. So he's a farmer, and so he actually owns a lot of real estate, a lot of land. And he also had experience that, well, if he does all his research and he's very prudent, he can make good picks on biotech stocks and other tech stocks, and really understand. Like, he asked me a lot, in technology, like, what's good to invest in. He was asking me about 5G the other week. So, you can really borrow against your real estate, and that's a great way for you to invest in the stock market. And that's one way you can just accelerate your gains. But again, you need to have net income positive. Okay, like, you're already covering, you're just trying to grow your wealth. And secondly, it's good to have those savings. Like, if you borrow some money, you have the savings. If the worst case, because again, it's a risk, so you might get unlucky, and you just have to have enough cushion that if the worst case happens, you're gonna still be okay. You're just gonna not quite have the growth that you expected. So that's that. Okay, so one easy thing to understand when it comes to financial freedom is compounding. So basically, it means the more money you have, the more you can earn, because you're always going to see a percentage return on your investment, right? And so the percentage means if you have $1, you're going to make 10 cents. If you have $10, you're going to make $1. If you got $100, you're going to make $10. And so this is actually the magic of how your savings can end up paying for all of your expenses. Once you save up like $1 million, wow, like 10% of $1 million, that is $10,000. Sorry, 10% of $1 million is $100,000. Like, that's just insane. That's crazy. Like, you can live on $100K a year, and with $1 million in the bank, essentially, if you're earning 10% interest through managing your money. And managing the money usually tends to take less time than having a full-time job, right? Because you do need to do a lot of research and understand how money works and how investments work. You might learn how to trade in the stock market or whatever you have. Like, there's a lot of different types of investments. But that's really kind of like the path to financial freedom for most people. So especially in regard to compounding, it means that over time, your money is actually going to be worth more. So this is why one of the first principles is to save more than you actually are spending, right? So you're saving. And so that's actually more every year. There's more and more money, which can earn interest. And so when you don't spend all your interest, you're actually reinvesting it. That's where the compounding comes in. So after 30 years, you can really double the savings that you have. Or like even after like 10 or 20 years, you don't have to wait all the way until you retire to see this like really crazy gains of like 2 times or 3 times your initial capital. And so that's only possible if you're reinvesting those gains back in. Okay, so if you're gonna achieve financial freedom, you gotta understand one topic, and that's about risk. So the thing is, everybody wants like a risk-free investment, but there really is no such thing, and I'll explain why. So even if you're going to invest in a relatively safe investment, there's things like mutual funds, even index funds, really they're just going to break even with inflation. And so we all know inflation, it's like the value of your money is going to decrease over time. Companies always raising prices, the government prints more money, and all this stuff. So basically, if you're going to invest in the safe investment, it's really just going to break even for you. And so you're going to have to take some kind of risk, and it depends what you're doing. If you're investing in the stock market or whatever that is, of course there's a risk, because if you invest in a stock, the company, even if it looks like the safest company to invest in, who knows what's going to happen. Technology is changing the world of business very quickly, and so you invest your money, and then suddenly, several months or years later, the price is just below what you bought it for. You're going to have to sell your stock and at least take back your money so you can reinvest it in a good investment. But in the meantime, you did lose some money. So that's always the risk that you're going to have. So the only thing you can really do is to manage your risk, right? So how can you manage risk? Well, so for one thing, you can diversify your risk. And so what that means is that as an example, let's say you got your money in like a safe investment, like it's bonds or something like that, which has a fixed return. So in that case, you're probably really breaking even with inflation, or you might barely be making money. But here's how that actually plays into a larger strategy, right? So if you have some stock investments, and let's say that your investments are down because the entire market is down. So in this case, it's not just that the company's bad and that you should reinvest necessarily. It's actually just that the economy goes through cycles, and sometimes it's up and sometimes it's down. And so by investing over time, you're buying when it's down, and then when it goes up and returns to its original price and then goes higher, that's when you're making all your money. So you're making all your money in the up market. So if you have these like safe investments that you're able to divest, so you're able to take your money out, so then you can actually take your money out of the safe investment, and in times when the market is bad, you can find the stocks in your portfolio that are at the best sale price, and you can actually buy them when they're cheapest, and you kind of double down. And that way, when the market is going to eventually go back up, you'll actually make way more money than you would have in the first case. So in this case, that risk of your entire portfolio going down, you're hedging that risk by saying, like, holding some cash to say that I'm going to buy stocks when the market's down. And so the point is that when the market's up, that money that's sitting in your safe investment is not going to make money, but overall your portfolio is going to make way more money because you diversified your risk in some way and you're rebalancing, right, during the right times. And so this is what you have to understand about managing risk. It's about the weather of the market. And so for each investment you hold, you have to know, when is it going to be up, when's it going to be down, when do I have to take a profit, when it has just soared up but it might fall again, and so I take the profit to lock in those gains and reinvest it somewhere else. When do I have to cut my loss? If it's down and it's just going to keep going down, you got to cut the loss and you got to reinvest somewhere where you're really going to have an opportunity to see the gains, right? Or when do you actually double down? And you take the money in the cash or some safe investment, you actually put more into that higher risk investment when it's at the best price, when you're really going to see the most gains in the future.
So, check this out. I went to the store and I got some awesome mezcal. No idea how it's gonna taste. So they said this is Sierra Negra, and it's supposed to be like kind of piney or smoky, or like a heavier flavor. So we're gonna try this out and really see how we like it. Okay, so now we're gonna taste this one and see how it goes. Ooh, that's smoky. Mm-hmm. Mm-hmm.